Ladies and gentlemen, welcome back to the Real Estate and Finance Podcast with Milton Andrade and Kimber White. Today we are doing this in person, live from RE Financial. Thanks, Kimber, for sitting down with me again today. There's been a lot that has happened over the last couple of months. I know we made some predictions back in December, and they did not come true, at least not yet.
No.
So tell me, what are you seeing out in today's market? Why do you think things are the way they are and the higher rates for longer?
The markets are changing and the rates are longer because two things. Number one, the economy is still booming.
Yeah.
I know people don't feel it, but the market is still booming. People are still spending money, whether they have it or not. They're using credit cards. And the housing market really has slowed, but it hasn't slowed. And at that point, and inflation is still high.
Yeah.
And when those two things are together, what people does, it binds them away, drives the bond market away. They're going to a safer place in the bond market. So we're ending up with higher interest rates. And that's what's causing our rates to go up. And the biggest thing is we hear, but the Fed's cut the interest rates three times. The Fed cut is for short-term interest rates. It is not long-term. Fed cut is credit cards, car loans, overnight spending, HELOCs, equity lines of credit. It is not tied to, that is the Treasury, that is not tied to the bond market, which we are tied to the bonds.
It's basically the money that the banks can borrow.
Yes.
Not that we can borrow.
Correct.
Right. And does that make the banks more profitable?
Yeah.
Okay. So basically, it's for the banks. But because our job numbers, like you're saying, the economy is still booming. And I know a lot of people are saying, well, I don't feel it. But unemployment went down to 4.1%. We've had 100,000 more jobs than were anticipated in the month of December. And now I know the Fed is going to be meeting in January 26th, I think. Do you expect there to be a rate cut given this information?
I think that right now it's still saying that the market is hot. I personally think that they're probably not going to do anything.
Right.
And I don't mean this rude, but right now, what I've seen on the past two Fed rate cuts, I really hope they don't, because every rate cut that we've had has drove the mortgage interest rates up. We had just before the first Fed rate cut, we had interest rates down to 6%.
Yeah, I remember.
As soon as the Fed did that 0.5 point rate cut, the interest rates drove up to 6.5% with their housing and the job market and their speech that he did. We did the second cut, and now we're at 7% on a 30-year fixed again.
Yeah.
So I'm like, Lord help us if we have another one, because I don't want to be over 7. We have had some stabilization in the market. I think it's settling in, but I don't expect to see, I just came back from a large conference, mortgage interest rates, from people's like, I'm waiting till, this Trump gets in and this is 2 or 3% and $2 a gallon, gasoline, whatever. Not happening, folks.
Yeah,
The president, as I had to tell a client this morning, the president does not control interest rates.
No.
And you're still going to have the same Fed chair that you had before. It is what the economy is doing and how the economy is working. Do we think we'll see some cuts? What we're saying is that by the end of the year, we'll probably end up about 6.25%, but we're not going to see below 6 interest rates. That's prediction this year. We were off a little bit last year, but we really weren't off that much. We said the settled average was in the mid-6s, and when you look and factor in it, it's probably about 6.75. So we weren't off that much. We're at 7% now.
I honestly was hoping for worse news regarding the economy because honestly, we really do need the economy to slow down in order to get affordability back to where people feel comfortable. But what I've told most people in this market is that I know it's uncomfortable. I know it looks expensive. It feels expensive, and you got to hold your nose to the market. But at the end of the day, this is where deals are made because there are fewer people in the marketplace. You just have to have the guts and the chutzpah to actually do it.
Well, I think one thing's talking about the marketplace. I have clients say, well, but the rate's 7%, the rate's 6.875. Here's what the rates are, where the rates are at. But what you're looking at, we're still growing equity in your home.
Yeah.
And they're still saying that the average in Florida grew 5 to 6% average overall, and it's still going to grow 4 to 5% minimum overall. So when you're looking at how much you're putting down in your interest rates, yes, it makes a difference. But there's also programs out there what sellers want to do. till this economy comes out, which I was never a buy down when the rates were low. Well, now's the time. There's what we call a 2-1 buy down, which means if there's a 7% interest rate, you can get your seller to help you with 2% down, which means you have a 5% interest rate for a year. Then you go to 6%. Then you go up to 7%. And we think the rates will, in the next 2 years, kind of come into line and be a little bit below that. But that gets you into your house for your first year or two and gets you start building equity into a home.
Now, let me ask you, because in the past, I would say, well, then take an adjustable rate mortgage. But if the Fed's overnight lending rate is going to really directly affect short-term lending, why hasn't the adjustable rate mortgage market actually been decreasing? Because they're almost the same as a 30-year fixed rate, so it doesn't even make sense to take an adjustable rate.
Adjustable rates just is not an appetite for it in the market, because what does everyone know? You're taking that on. When you're doing an adjustable rate, the investors, so people understand, they buy your mortgage. They need to make money off of servicing your mortgage. They know that you're going to refinance out of your mortgage, out of that, as soon as that interest rate drops.
Right.
So there's just not an appetite for it, plus the curve is just not there, and that's why. It's just investors not wanting to wade into that pool of adjustable mortgages because they know at some point what goes up must come down, and that it's not profitability.
So it's not profitable for lenders to do it, and
No.
there's no way that the government, because the government doesn't directly loan money to clients,
No.
that's not going to exist. It's not going to occur.
Unless you're going to a private credit union or somewhere like that and getting a short term, but then again, there's points and things like that involved and stringent guidelines and a lot tighter credit guides.
Okay. Now, in terms of the market in general, I've noticed that we actually have more choice, aka higher inventory. It's nice to say more choice, but listen, face it, at the end of the day, buyers have more choice. And I think that's a good thing, but at what point does more choice, higher inventory equal problem, and now we have an oversupply?
Well, I think what I'm seeing, and I'm looking at the average daily, where are we at? What is the average marketing time? I mean, you better that on the market. 90 days, 120 days? When you look at
77 days is the average.
My opinion, 38 years, that's an average market. We seem to forget, because we have all been, those of us in the real estate and mortgage business, that 5 days was a market, or 24 hours
Short
on
memory.
some.
Everybody's got short memory.
We have short-term memory,
Yeah.
but overall, long-term memory, an average marketable for sale home is 90 to 120 days. Everyone prepares for that. There's a quality inventory. See, I take a different stance on that there's finally inventory freeing up, and that we're finally getting buyers who are starting to come out. I'm starting to see buyers realize, okay, rates aren't coming down. I'm renewing my lease. I got to buy. So I've got to either make a decision if I'm going to rent or if I'm going to buy. It's still the best time to buy. You're having to, and you're going to get better deals.
Yeah.
Because people's like, at what time? There wasn't any bad deals really made. And this is unlike 08, 09, and 010, when there were bad loans, no equity, people upside down in their houses. We have more equity in people's homes than any time in the recent history in the United States.
Right.
So even if people are told that they can't make their payments, they have to sell, we're not going to have that downturn and that craziness. So I don't think we've reached that point. When you start telling me that I've got a 6-month inventory, then I'm going to sit there and go, we're in trouble.
Right.
But we don't. When I look at the inventory, when I moved here in 05, 20 years ago when I moved here, and I look at what the statistics say now, we're about on average when I moved here in 05 as far as inventory is concerned. And that the average time when I went back and thought about it and looked at it, you're 90 to 120 days.
And that was before a construction boom.
Right.
So we're not really going to have that construction boom because we're very constrained on land. There's no really where to build, at least in our immediate market. So this normal market is probably short-lived.
Well, and the other thing that was brought up at the conference I was at was for every one house, there's 10 people coming to the housing market over the next 5 years. Mm-hmm. Mm-hmm. And the next 3 to 5 years. And in the next 12 months, there's about, for every house, there's at least 3 to 4 people. There's more more people getting into it, millennials, Gen Zs, that's coming into the housing market than there are houses available, and there's no more land to build on.
Right.
And,
Right.
and we're running out of land, especially when you look at Florida and South Florida.
Yeah.
You know, so you're never going to catch up to a 6-month inventory because you have more buyers in the market. If you're looking through the city right now, you have rental income, rental going up, up, up.
Yeah.
And they're not really that empty. Rents have come down a little bit because rents are overinflated. Everybody's like, oh, I saw the rents come down. Well, of course they did, because you're overinflated.
We added a lot of inventory.
We added a lot of rental inventory, but we were overinflated, and it was in housing and rental prices anyway. Even housing prices, and I know realtors don't like me to say this, but we're overinflated. You cannot have a stable quality economy having people building 50, 60, 70, 100% equity, in which you saw, in their house in a 2-year period.
No.
It's not sustainable. It sets us up for a crash. So we all had to say, the water spigot turned off probably a little bit too fast.
That's the rates.
Right, that's rates.
The rates.
But the Fed chair did do the right thing, in my opinion, because we couldn't keep this out of control housing spending, because then we would have had a bubble. Because it's, I call it funny money and funny equity. But now we're catching back up to the equity. So when people's like, oh, I got a 3% decrease, or you got a 3%, you really haven't had a decrease in your value. Your value is still setting back. But look at the average person is still setting on almost, it's bought in 2020, 100% equity in their house.
And we really haven't seen any decreases, really. When people say 3%, 1%, honestly, maybe in some condo markets, but property values have not dropped.
No.
And if you look at the sold prices based on the asking prices, the asking prices have seen reductions. But that was never the true value, because if you were to base that based on the closed value of similar property, they have not gone up tremendously, but they have not dropped.
No, they haven't. And I think that's what we have to look at. And then people look at me and say, well, what happens when you're getting into the market now? Hasn't all the equity been built up in the equity, and now I'm buying someone else's equity when I'm buying this house? No. You're starting to build your own equity.
Right.
I will say again, you're going to rent an average place that you're looking $3,000 a month. That's half decent if you want something nice. And you're going to throw away $36,000 in a year. And you're going to lose, let's just say on a $400,000 property, let's just make it conservative and do 4%. That's $16,000 in equity. Mm-hmm. So that's $52,000 plus the tax write-offs that you got. You've just given somebody else $52,000. So if your mortgage payment's a little more than what you would pay for rent, aren't you investing into your future?
Right. You're paying down your debt. You're also getting the tax incentives. You're writing off the mortgage interest from your income. You get a lot of different tax deductions. I personally, I even have an investment property that loses a little bit of money, but that actually helps me keep a lot of the income from other investments. But so what I'm noticing in this market is that even people who bought and decided they didn't like the home within 2 years and they wanted to resell it, they're not losing any money.
No, they're not losing money. They're still getting out and making money on it.
And that's not the most ideal way. I say if you're buying real estate, you need to keep this for 5 to 10 years. It is not a short-term investment. But even the people that did buy, I have one client who purchased 6 months ago, right? And now he decided that, honestly, he wants a larger unit. He wants to sell his unit. We're still able to get him nearly 8% more than what he bought it for.
Right.
Which will cover any of his purchase and sale expenses. So he would have been able to have bought and sold without losing a dollar.
And living in it still.
And living in it. Right. He's not paying rent.
Right.
You know, and so, you know, I understand some people will be uncomfortable and afraid and think that it's not fair because you know, everybody deserves a house and this is not right. Okay. Unfortunately, the reality is the reality, and that what we're living. And you have to take ownership of your future, and that is through real estate, right? In the United States, the most common way people build wealth for their family, is real estate. It's nothing else.
It is. I mean, and when you're looking at building wealth, what do you build it off of? Portfolios that come and go, or your home? And your home is your most important thing. And a home gives you a sense of place.
Right.
And a sense of worth in everyone. I think that we're starting to see more of the younger generation starting now to say, okay, I want to buy a house.
Right.
I think it's house time. But don't let rates scare you. And I tell people that. But sitting on the fence, and I had a client call me yesterday. Well, I've been waiting for the rates to go down. And I was like, and they were 6%.
Has he been waiting since 2020?
2021.
Since I knew it. Okay, how did I know?
2021.
So many people have been waiting for the market to crash.
Yep.
They've been waiting for rates to go down. They've been waiting. Meanwhile, their rent has nearly doubled, and now a lot of them are even, priced out of the market. And I'm a son of an immigrant. My father's first mortgage in 1983 was 15.8%. Yeah. But the equity that he built in that home helped us move from Queens, New York, to Nassau County, to going to private school, to moving from one house into a larger house, to eventually moving into Miami and moving into a nice new construction property. If he didn't start, we'd still be living in Queens.
Right.
Not that there's anything wrong with that. I like Queens.
It's a quality of life, and it makes a different change, and it makes your life different. And you've got equity. I mean, I go back and look at myself, that when I sat there and said, I left this, I went through the crash. I had 6 properties, bought them, lost everything. And I was gun shy buying properties. What the heck am I stupid and doing?
Right.
But I realized I'm telling you to buy properties, and I don't own properties.
Right.
And it's still, and even in 17 and 18 when I bought, I'm sitting here going, the rates are still too high. They're in the 5s. I don't really have any money.
It was 5.
It was 5s. 5.5. I don't have any money. I'm going to have to put 3% down. I'm going to have mortgage insurance. I've reestablished my credit. And I'm going to pay more for a house than what I'm paying rent right now. Why? But I did. And then I put them in. But I'm sitting here 6 years later on a house that's got over 100% equity into it.
Yeah. Yeah.
And I've taken write-offs and I've lived it. What I'm saying is, if you don't take the leap now, you're going to look back. Like most of my clients are calling me now that have been on my books 2, 3 years, 6 months, 8 months, 9 months. And you're going to say, what am I doing? And why am I doing it?
Right. Well, let's talk a little bit about that because, thank you for sharing, because I also had multiple properties in the late first decade of the 2000s. 2007, 2008, when the market tanked because we had a huge mortgage meltdown. That is not something that we're nearly at risk for today.
It's not going to happen.
Back in the day, it was, what's your name? Here's $500,000. Here's $1 million. They didn't even need a social security number. The mortgage lack of regulation was astounding. And that's why there was a bubble and a crash. Yeah. But what we find ourselves in today is it is harder to get a mortgage. Yeah. You have to be fully qualified. It's all full doc, even though there are some stated, no doc loans. It's 20% down, 30% down, higher interest rates. It's not what it used to be. So because the mortgage industry is well regulated, we do not have people who are upside down. We don't have people who cannot afford their mortgage. Everybody's affording their mortgage. Right? We have a lot of people who can't afford their rent. That's a different thing. Mm-hmm. And that's because they really do need to make those changes, make those sacrifices, and actually become part of the system and buy into it and get yourself a single family home or an investment property, or even buy a property outside of the market where you live, because you need to get started building your equity and building that nest egg for your family, even if you're renting. Right, and that's what I tell people. I'm like, don't get discouraged. Like, if you live in Miami, you can't afford a property in Miami, look in Jacksonville. Right,
and I think that is something that, and I told my story because so many people tell me, well, I'm afraid this is going to happen. I'm afraid I'm going to lose this. We have the bumper guards, the safeties in place. That's not going to happen.
Yeah.
You're not going to end up with the crash that we had. And that's the other thing I hear. I'm going to wait till all the foreclosures happen.
What foreclosure?
It's not happening.
Yeah.
The average interest rate is 3.5%. The average person is sitting on at the very least 80% equity in their property. Some 100, 200% of equity.
And 42% of all the homes in the United States are paid off. They don't have any
Right.
mortgages.
It's just not happening.
No.
And so I think that we're probably at the most equitable position for homeowners that we've had in recent history.
Yeah.
Since I got in this business, which I got into it 38 years ago, I think we've seen so much equity. But there are also programs out there when you sit there and say, well, I can't afford 20% down. I can afford 10%. There's first-time homebuyer programs. And the real thing is, don't go after your Taj Mahal or your castle to start off with.
Right.
Aspire to your castle. Start off with your cottage. Start off with your investment. Start off with your small. This is the starter home. This isn't your life dream home, which I think that's where most people go into it. I'm going to live in this house till I'm 60. I don't know anyone
nobody does.
Start with your starter home. And as Milton said, go somewhere else. If you can't afford here, move or move somewhere if you can move. If not, at least buy an investment home. You still have to rent, but buy a piece of property. Get something moving. Start being now. Because I think by the end of the year, I don't think we're going to have the market that we have now. I think we're going to be in a market that people have adjusted. I think that the end is going to end up happening that you're going to end up with less buyer's market, more gearing toward a seller's market. And I think even a 0.5% movement rate is going to turn
It'd be
that.
a huge dramatic shift in the market because we have all that pent-up demand. But let's talk about insurance and natural disasters. Because as we are filming this, there are fires raging in LA. And there are a lot of homes destroyed. Some lives have lost, but luckily that's not a very big number. But there are hundreds of homes that have been destroyed. And because of the changes in the insurance market, even 3 months ago, State Farm canceled over 70% of the policies of the people in the Pacific Palisades. And so many of those homes that were burnt did not have insurance. Right. Now, how could they have not have insurance? They had to have not had a mortgage.
Right.
Right?
Right.
So there's a lot of wealth that just evaporated.
Yes.
From many people's lives. In South Florida, in our market, I know that there are a lot of people that have challenges with insurance, but everybody has insurance.
Yeah, I think most people have insurance, and that is a terrible disaster. It's horrible as we're from that's happened. But this is also another situation that you say that I'm going to go without insurance. I'll wait. I don't have. Another example of insurance is never too expensive. It's too expensive as far as, yes, paying, but at what cost do you go without insurance? And if you have a mortgage, you've got to have insurance. That's the way it is.
Right.
There's always insurance. Insurance is an issue that everyone's fighting. In Florida, we've had 3 hurricanes this year, in this hurricane season, and we are working and fighting to help get the insurance down. The government. But I'm going to go one step further. When everyone here says, how about a state-funded system? Let me give you what was said by the former insurance commissioner on television the other night of California. Mm-hmm. Number 1, State Farm canceled the policies. Number 2, there was a state-funded policy. We could self-insure and the state would fund and take care of you. That fund cannot handle this, nor could a fund in Florida handle a disaster like we've had recently with hurricanes. Now it will go back onto the insurance companies for those insurances to pay out. The insurance companies will not have enough money to pay all those claims out.
Right.
What will end up happening, even through the state fund, is the state fund will go broke. They won't have money in it. There will be large assessments on homeowners, and there will be huge policy increases. So
is that going to be just California?
That's California. I mean, I'm just saying California. I'm using that example. No. But what happens in Florida when we talk about the state doing state-funded, self-funded.
That's citizens, right?
That's citizens. And when we talk about paying into a fund, us, like California, these are the consequences. It's just like our condos right now. Our condos chose not to insure themselves properly. They chose not to raise HOA dues. They
Not to
chose to
fund their
defer
reserves.
maintenance, not to fund the reserves. And I say when I got into this business 20 years ago here in Florida and started learning about condos, when the first crash happened in '08, I'm like, you're going to have problems in years to come if you don't do something. And of course, it was one ear and out the other. Now, what's happening? Condo dues are up. Assessments are up. This is the same thing with insurance. We have to work through it. It is hard. It's expensive. But when you look, what is it worth? The answer, I don't know. It's one of the most expensive things that we pay for, because I go to North Carolina, and I look at what insurance is. But insurance is a necessary evil. We just have to work on what we need to do with insurance. But I don't see the insurance going up huge amounts because of the floods here. The hurricanes here, or even the flooding that we've had here. I think that we have enough stability here, and also new insurance companies are coming into our market.
Yeah, I think our area has settled a bit, and our insurances are starting to level off. But I will say though that the largest part of an individual's mortgage payment is the taxes and insurance.
Yes.
Right? It's not even the mortgage. It's not even the principal and the interest. It's the taxes and the insurance. And so if we had some reform to be able to, I guess, spread out the risk a little bit more and therefore bring prices down, we could probably see some relief. There's even a bill to get rid of all real estate property taxes. I don't think that's going to go anywhere, but there is a senator that is proposing a bill to get rid of real estate taxes in the state of Florida entirely,
right,
and then just charge consumption tax. You know what? That'd be something. But I honestly don't see it happening. But what changes can we make that would make homes more affordable, that wouldn't bring prices down, that would also not underinsure us, still collect enough taxes to fund our roads, bridges, schools, etc., and interest, and give interest rates, where banks would want to have it. It's like, how do you keep everybody happy and bring prices down?
Well, I think what we have to do with that is, number one, is that we have to look at, if you're getting a home, unfortunately, I hate to say this, make sure you deal with a real estate and a mortgage professional, especially a mortgage professional, that doesn't just get you the mortgage, that looks at your insurance, that looks at your policies, because insurance companies are salesmen. And I hate to say it that way, but they're a salesman. And they're going to sell you the Cadillac when you might not need anything but the average car. You can be overinsured just as much as you can be underinsured. So look at your policies, know what you're getting. I think that's one of the things in education. When it comes to taxes, I would love to see no taxes or lower, because taxes go high. I would love to see a consumption tax on, because the one problem that in the state of Florida is we do not pay state income taxes.
Right.
So except for sales tax, that the person who does not own a home really has no skin in the game. Don't mean that wrong. Don't mean that harmful before I say that, but it's the facts.
Yeah.
The people who are really keeping this economy going in the state of Florida,
or at least funding our government,
are funding funding our government and funding our roads and everything else, is the people who own properties. Is all of us homeowners. And I think there has to be some even distribution, because if you're not paying property tax, you're not paying income tax, you're paying just a little bit of county tax or local tax. Are you really fairly contributing to the economy that we are all contributing to for you?
You know what's crazy is I think between all the properties, I think I'm spending $40,000 to $50,000 a year in real estate taxes.
Right, I pay 20.
And I don't have any children in school.
Right.
So,
right.
But at the end of the day, I want roads, I want bridges, and I want schools. But I think there needs to be something done to bring those costs down, because, when I think about government budgets, especially our local government, in 2015, when they were bringing in half of what they were bringing in today, we still had roads, bridges, firemen, police officers, schools. Where's all the money going today?
I think my opinion is when I look at it's a lot. It costs a lot more infrastructure, a lot more development. I probably didn't see it as much, but now that I chair a CRA, which is a redevelopment area for our city, it's a small quadrant, actually a large quadrant. I see what the cost is to bring what we want to do in the development and all that stuff. So there's a high cost. There's infrastructure costs. There's sewer costs. There's fire costs. When I look back and say, golly, I don't want to pay those taxes. I don't want to pay this. But then I look at the underfunding and the funding cut of firefighters and emergency services in California because they lost so many people to other states.
Yeesh.
And they lost so much that you're sitting there and they're showing that fire trucks are sitting empty and uneven, and that they're sitting there because they didn't have the help, and they had a shortage of firefighters and a shortage of emergency personnel, which led to this burning, whether you believe it or not.
Of water.
And a shortage of water. Do I pay for my safety? Yeah. Is it sometimes high? Yes. But we have to look at, when we look at Florida, when I moved here in 2005, we had one of the worst funded states that there was. The income was down. The taxes were done. This is not talking about administration. We have some of the strongest economies that there is. We have some of the strongest coffers that there are. Whether we like whatever politics it is, we have to say that economically, this state has thrived over the past 10, 12 years.
Right.
And yeah, so now they could cut back a little bit. But as far as going back to buyers and what you can do to buy a home, be diligent, do your homework, don't overpay. Have a quality real estate professional that's telling you what the value is and that gives you your option. Don't just go out there. And if you're listing your home, this is the biggest thing I can say, and I appreciate Milton so much. If I've got one of Milton's listings and he's got the buy side or he's just a listing, I can call Milton and say, if the appraiser's starting to come in short, hey, Milton, can you please give me how you came to this value? You do not understand the number of real estate agents I call, and it's, well, the seller said, or the market is,
right.
Can you show me your comps? And they're scrambling and looking for comps. And if I go to Milton and his team, they're like, oh, here's what we did as the buyer's agent. This is what I think it's worth. Yeah, it's probably worth. That is what I call having a true professional. And if you're looking and want to say what can you do to keep real estate better, is make sure you're dealing with a professional.
And it's not just the list of the comps, but also like the improvements, when they were done, how much it cost, and why this is different than others, and really be able to like whittle down so that we can get the just and fair price of the appraisal for the seller, but also for the buyer. Right, it's got to be fair on both sides, and having a professional is really important to be able to navigate those roads in this market, in the changing dynamics of the market.
And I think one thing that is really still confusing, I want to bring up, is the buyer's agreement. No one wants to bring that up, and I'm getting confused. We're requiring it as a mortgage professional. As a buyer, when you go in, what is a buyer's agreement? Well, you know the new law is that the seller doesn't have to pay the commission to the buyer's agent, but you need to know that going in. You don't need to assume, and I think you need a professional to make sure. Hey, is your realtor negotiating the fee? Are you paying it? I'm starting to see so many contracts that I'm hearing the words, "I assumed that the listing agent was going to pay it." No.
You should get
that right
ahead of time,
right,
before even showing the property. But here, I'll tell you really quickly. I had a situation happen recently. I had made an offer on a property. I was representing the buyer. Before we even engaged the seller to even look at this property, because my buyer brokerage agreement states that the buyer says not to show me any properties where their sellers are paying less than X, because they don't want to have it fall on them, because they've done their math with their cash to close, their purchase and everything, and they have a specific budget. So I said I would not show the property if it wasn't offering X as per my buyer agreement signed by the buyer. So this agent said the commission was a certain amount. And so we start negotiating. I make an offer. They counter. We're going back and forth. She calls me on a Saturday night and says, hey, the sellers have agreed to your counter. I go, fantastic. I'm going to make the changes to the contract. I'm going to send it over to you. She sends me a change contract the next day with a lower commission.
Oh.
And changing a whole bunch of other terms in the contract. And I explained to her, I'm like, you cannot negotiate my fee. That's up to me. Because what you did was, by reducing my fee paid by the seller, which is in contradiction to what you stated initially as per text, email, and document, you basically just increased the price on the seller, on the buyer. So therefore, the seller did not accept my offer.
Right.
And that would have been more straightforward had you just said, the seller does not accept X, he accepts Y. As opposed to saying, he accepts X, and then the next day, fine print. Well, long story short, the seller is still selling that house, and we're in contract on another one.
Right.
So sellers need to know that you can't change terms like that now on the fly, especially in a market where inventory is rising and you're not the only one on the block. So if I'm representing a buyer, I have to make sure I'm getting the best deal for my buyer. And that includes negotiating my commission sometimes, but not having the seller do it for me because we found a better deal elsewhere, because that's a tax on the buyer. And that's what,
Right.
So it's a little bit more nuanced today. And therefore you have to have the right agent that's either representing you as a buyer or representing you as a seller, because at the end of the day, we both got to work together to make these deals happen.
Yeah, and I think telling Bernier is that before you go looking at houses, get pre-approved. And what is pre-approved? Pre-approved doesn't mean calling the bank, running your credit, and getting a letter. That's not pre-approved. That's anyone can do. Pre-approved is actually sitting down with a mortgage professional that you know about. And why do you need to be pre-approved? You need to be pre-approved because you might want a house that's $500,000, but you may not qualify for that. Or your payment. I ask the first person I ask you when you come to a home from me is, how much house do you want to make a payment for? Well, hey, I want a $2,500 a month mortgage payment.
That's $300,000.
Right. That's a $300,000. That's not a $500,000 house. And then you may qualify for a lot more. But if you want to be in that payment range, your real estate agent needs to know. Because I don't think, because you just said taxes, insurance. People don't understand. They calculate what my mortgage payment is based on the house. They're not calculating taxes and insurance. It's always best, to get pre-qualified with a mortgage professional, plus to see what kind of down payment options there are, especially first-time home buyers. There's a lot. Do you qualify for any? Is there anything we can do for you to get that happening? Is there a way that we can negotiate and come back and go, hey, they need closing costs, Milton. So we need to, when you're out there negotiating, they need to know that there's closing costs that's involved. So there's an important thing. The first thing you should do when you contact your realtors, after you contact a realtor, immediately, and Milton always does, is contact a mortgage professional.
Yeah. And I like to run through different scenarios, because you may do FHA, you may do conventional, you may do a bank statement loan, there's a couple of different ways to actually, find that right solution for the home. So yeah, definitely you got to work with a banker and a realtor who can work together, right, going over the different scenarios to make sure that you're getting the right deal for you on the home that you want.
Yep.
All right. Well, Kimber, thank you so much for taking the time to speak to us today. It's a pleasure as always, and it was really great to actually do it here live in person in your office. Thank you so much for taking the time today.
Thanks.
Take care, everybody.